In this week's video, we'll review the latest charts to give us a better understanding of who's winning the ongoing battle between the bulls and the bears. On the left side of our screens, we have a weekly chart of the S&P 500. This is calendar year 1973. This is a downtrend into calendar year 1974. If we look on the right side, this is an uptrend in the S&P 500. It's also a weekly chart with weekly Bollinger Bands. For now, from a generic perspective, this is what a downtrend looks like. This is what an uptrend looks like. And as we look at this weekly Bollinger Band chart of the NASDAQ, keep in mind that a downtrend in the NASDAQ looks similar to a downtrend in the S&P 500, which looks similar to a downtrend in the Dow, which looks similar to a downtrend in crude oil, bonds, or anything else that we can think of. The same can be said for uptrends. If we looked at a daily chart, the NASDAQ Composite Index peaked. The major bull market peak was on March 10th of 2000. This weekly chart is 111 days after the daily chart peaked on March 10th of 2000. If we looked at a daily chart in 2007, the highest closing high for the NASDAQ was on Halloween or October 31st, 2007. Similar to this chart here, this chart shows the weekly NASDAQ chart 111 days after the NASDAQ daily chart peaked. And before we move on to the present day chart of the NASDAQ, let's make a couple of points. This is what a correction looks like on the weekly chart within the context of an ongoing uptrend. This is a normal and 100% to be expected counter trend move within the context of an ongoing uptrend. The same thing can be said for this pullback here. Why? Because eventually the market went on to make a higher high. Number two, why 111 calendar days? In the present day, the daily chart of the NASDAQ peaked on January 26, 2018, or 111 calendar days ago. Before we flip over to the present day chart, it's logical to assume, since we're comparing apples to apples, 111 days after the peak, 111 days after the peak, and 111 days after the peak, if in the present day we expected something similar to a rollover from an existing uptrend into a long-term secular downtrend, a rollover from an existing uptrend into a long-term secular downtrend, it's logical to assume that the present day chart would look something similar to the look of this chart here, 111 days after the peak, and or the look of this chart here, 111 days after the peak. Is that the case, or does the present day chart look significantly different? The answer is it looks significantly different. 111 days after the NASDAQ peaked in the year 2000, the Bollinger Band, weekly Bollinger Band center line had rolled over. We can see this right here. Similar situation in 2008. The center line, for the most part, had a positive slope. This looks quite a bit different than what we have over here. Now it's down. In the present day, we don't have anything even remotely close to that. As of the close on May 17th, 2018, on the weekly chart, center line had a positive slope. Similar situation, 111 days after the market peaked in 2000. The lower Bollinger Band, notice the slope of it. It's rolled from a positive slope to an indecisive look to a negative slope. 111 days after the peak in 2008. Positive slope, indecisive slope, negative slope. 111 days after the peak in January of this year. Positive slope. Why is this relevant in the present day? The left side of this chart here tells you if we consider all of the information available, all of the fundamental information, interest rates, Fed policy, earnings, valuations. This tells us that the net aggregate opinion of all market participants was bullish. How do we know that? We have an uptrend. Over here, we can see that the net aggregate opinion is flipping from bullish to bearish. The net aggregate opinion of all market participants related to every single possible subject that we can think of is bullish here, and then it flips over to bearish. In the present day, based on the facts that we have in hand today, not talking about what's going to happen next, what we can see, measure, and put in a model, what's in front of us, the net aggregate opinion still looks constructive here, and it looks quite a bit more constructive than this point here and this point here. And it's extremely important to note, we have to compare this point, and this point, because all three of these are 111 days after the peak. And as we know, all that helps us with is assessing the probability of good things happening relative to the probability of bad things happening. And remember earlier, before we reviewed the 2018 chart, we said this is what a normal and 100% to be expected correction looks like within the context of an ongoing uptrend. Here's another example here. It's pretty fair to say the look here, the look here, and the look here, this, and this are quite a bit more similar than this, and this. Is it possible that the present day chart morphs into a look like this or a look like this? We know the answer. It's absolutely positively yes. But the important thing is it hasn't happened yet, and we'll continue to take it day by day. Now remember, we reviewed these charts before we biased ourselves with the present day chart of the NASDAQ. This is what a generic downtrend looks like. This is what a generic uptrend looks like on a weekly chart using Bollinger Bands. Let's spread these two charts out, and let's slip in the present day weekly chart of the NASDAQ and compare them head to head. May 17th, 2018, center line, positive for the NASDAQ, 111 days after the peak. The lower Bollinger Band has a positive slope. This is an uptrend here. This is an uptrend. Similar situation during an uptrend in 2013, where the market went on to print a series of higher highs and higher lows. Center line, up. The slope of the lower Bollinger Band, for the most part, up. In fact, you can say in 2013, the S&P 500's trend here was more indecisive, meaning the bears had gained more ground at this point in 2013 than the bears have gained relative to the bulls in the NASDAQ in 2017. This is a strong uptrend look. This is a more indecisive look. And yet, the market went on to print a series of higher highs and higher lows and continued the uptrend. Does the present day look anything like our generic downtrend? The answer is obvious. The answer is no. Slope is down, slope is up. Lower Bollinger Band, clearly down. This is a downtrend here. This is an uptrend. We're not using these charts to forecast. We are simply looking at the facts in hand and assessing the probability of good things happening, or the probability of higher highs relative to the probability of bad things happening, or lower lows, looking out several weeks, months, and years. If you were told this is the look of the small cap ETF IWM 111 days after the market peaked in late 2007, so we're looking at a chart in early 2008, you would have said, not particularly surprising. How does the exact same chart look today, 111 days after the NASDAQ originally peaked, and when the S&P 500 also peaked on January 26th, 2018? The answer is quite a bit better. The center line for the Bollinger Bands helps us filter out the day-to-day volatility and focus on the trend. You can see here the trend flipped from bullish to indecisive to bearish. 111 days after the peak, this is the slope of the center line. Compare and contrast that to the slope of the same center line 111 days after the markets peaked in 2018. It's also noteworthy, IWM here is making a discernible series of lower highs and lower lows. In the present day, we're making a series of higher highs. This is a new high here and higher lows. This really doesn't look anything like this, and this tells us a lot about the net aggregate opinion of all market participants, all of the bears and all of the bulls. It tells us a lot about future expectations about the economy, earnings, and the sustainability of earnings growth. As always, is it possible that this chart here morphs into something like this? We know the answer is yes, but it hasn't happened yet, and we'll continue to take it day by day. We make decisions based on facts, not fear of what might happen or a forecast of what may or may not happen. We're comparing apples to apples here. 111 days after the markets peaked, 111 days after the markets peaked. We're also looking at a very similar time frame. This is 1 year and this is 1 year. This chart here doesn't look anything like this chart here. Similar situation here. Energy, XLE, relative to TLT or long-term treasury bonds in the ETF world. We have lower highs and lower lows. How does the exact same chart look 111 days after the peak in the present day? The answer is quite a bit better. Instead of lower highs, we have higher highs, including a new high being made in the month of May in 2018. As we all know, one of the most difficult things in the markets is curbing your emotions and making rational decisions. Not only do we have to deal with emotions, but we have to deal with personal bias and our egos. Most of us can make intelligent decisions if our ego isn't involved, emotions aren't involved, and bias isn't involved. So to remove the bias from these charts, let's strip out the symbols. If we were taking a technical analysis test and we said that we wanted to invest in a long-term uptrend that would give us an opportunity to navigate between a point A and a point B that could be several years down the road, and we wanted to make money, would we prefer to own the chart on the right or the chart on the left? The answer is pretty easy. It would be the chart on the right, or selection B. Same situation here. We have a different set of charts. If we were asked the same question, the answer would be easy. If we wanted to navigate between a point A and a point B that would be several years potentially down the road, it's pretty obvious we would prefer to own the chart on the right. And if we were trying to make money, we were trying to navigate between a point A and a point B several years down the road, we would most likely want to avoid the chart on the left. Same question here, and like the other two choices, it's obvious. The answer is we would rather own B, and most likely we would want to avoid A based on the facts that we have in front of us today. Seeing a trend here, this would be an easy test because the answers are the same in every case. We would want to avoid A and embrace B. This is clearly a long-term downtrend, and this is clearly a long-term uptrend. Different set of charts here, same results. We prefer to own B, probably want to avoid A. So let's double back to the first set of charts and put the symbols back on the charts. In every case, choice B seemed to be the better choice relative to choice A. In this case, we have small caps IWM relative to the triple Qs, which is a tech-heavy ETF. The more desirable chart, we just flip it around. This is tech relative to small caps. These charts help us with long-term probabilities. Here's the next set of charts. If we put the symbols back on, we can see the long-term trend for energy XLE relative to the triple Qs remains down. If we flip it the other way, we can see the bullish variant. The last major thing that happened on this chart was a new high here. We have price above an upward sloping long-term moving average. There's no question energy is making strides on shorter and intermediate term time frames. The purpose of the exercise, energy still has work to do relative to the triple Qs on a very long-term time frame. Next set of charts, let's add the symbols back. On the left side, we have global stocks relative to the triple Qs. On the right side, we invert it. We have the triple Qs relative to global stocks. From a long-term perspective, the trends in the charts speak for themselves. Next set of charts, let's add the symbols back. AMJ, which is a basket of master limited partnerships relative to the triple Qs. Flip it around the other way, we get the triple Qs relative to master limited partnerships. Before we go to the next slide, this is symbol AMJ, master limited partnerships. In the next example, we use a different symbol. This is AMLP, also a basket of master limited partnerships relative to QQQ. Flip it around, QQQ relative to AMLP. Hypothetically, if you owned AMLP, you might come back with, but AMLP is paying an 8% dividend. That is true. However, if we go back and compare the performance of the two between March of last year and the present day, we see the triple Qs. This is total return. So we're looking at everything here. This tells us the return for the triple Qs is roughly 30% over this period, going back to March of last year. That includes growth, share price appreciation, plus dividends. AMLP, share price appreciation, plus dividends. Well, in this case, we do not have share price appreciation. The share price dropped. The total return was roughly a loss of 11 to 12%. So let's assume back in March of 2017, we took $2 million, and hypothetically, we're using an extreme example here to illustrate basic concepts. By no means are we advocating that anyone would put all of their retirement funds in the triple Qs or a tech-heavy ETF. We're simply illustrating basic concepts, the concept of growth and dividends and total return. Hypothetically, if we invested $2 million in the triple Qs with a mindset that I need to protect and grow my account, the return between point A and point B that we just covered was 30.15%. Hypothetically, my $2 million would be worth $2.6 million as of Thursday's close. Conversely, if I focused only on the dividend and the fact that I'm retired and I need income over the exact same period, the total return for AMLP was a loss of 11.67%. My $2 million would have turned into $1.7 million. This investor has $2.6 million hypothetically at the end. This has $1.7 million. The investor with the mindset that I need to protect and grow my account would have $836,000 more at point B than the investor that only focused on income needs. Moral of the story: you can pay a lot of bills with $836,000. It's fully understandable when people retire, especially when they have a lump sum to invest, that they feel, I'm retired, I need dividends and income. In all environments, especially the present day environment, it's extremely important to keep all of your options open. It should be, I'm retired, I need to protect and grow my account. The objective is to make your account balance grow. If it's prudent to do that with dividends, that's totally fine. There's nothing wrong with dividend-paying investments. If it's prudent to do it with growth-oriented investments, there's nothing wrong with that. If it's prudent to do it with a combination of the two, that's also 100% fine. The important thing is, the market determines what's prudent. In some environments, dividend payers have an advantage over growth-oriented investments. In some environments, growth-oriented investments have a huge advantage over dividend payers. And that would be the case in this look-back period that we have here. It's quite obvious based on the account balances. How do I know my strategy is working? If my account balance is growing, I'm probably doing all right. If my account balance is going backwards, despite the 8% dividend, then I have a problem. Again, this is an extreme example to illustrate basic concepts. Under our approach, we don't care how we get there. We want to take what the market's willing to give. If it's dividends, that's great. If it's growth, that's great. If it's a combination of the two, that's fantastic. And again, we're using the triple Qs or a tech-heavy ETF because technology is the present-day leader. It's the reason why we're using tech in all of these charts. If the present-day leader was gold, we would compare everything to gold. If the present-day leader was banks or financial services companies, we would be comparing the ETFs to banks and financial service companies. There's no bias towards tech. Tech just happens to be the market leader at the present time. How long that will last is anybody's guess, and it's to be determined. If we look at these charts here, the same concepts apply to dividend stocks relative to tech. It's not just master limited partnerships. The long-term trend between dividend stocks, DVY, and the triple Qs is down. The long-term trend between the triple Qs and DVY is up. Again, how long this will last, anyone's guess. We don't predict. This is what we have in front of us today. All right, let's move away from tech because we said we were using tech because it's the market leader. How about if we look at master limited partnerships just relative to the entire stock market or the diversified S&P 500 index? Similar situation. AMLP relative to SPY, long-term downtrend. SPY relative to AMLP, a long-term uptrend. Like any trend, we always have normal and 100% to be expected counter trend rallies within the context of an ongoing trend. How long will this trend remain in place? We have no idea. We take it day by day. So if we take a broader view that I'm retired and I need to protect and grow my account, it's much, much easier to look at these charts in an unbiased manner. Dividend stocks, DVY, were outperforming growth stocks over here in 2016. Now the ratio is making a series of lower lows and lower highs, and the long-term monthly moving average is rolling over in a bearish manner and prices below the moving average. If we flip it around, growth stocks relative to dividend payers, we were below a downward sloping long-term monthly moving average. Now we're above an upward sloping, positive long-term moving average. These concepts and the concept of total return versus an I need income mindset within the context of the present day, the facts that we have in front of us today, interest rates, earnings, Fed policy, etc. All of that is covered in detail in this short takes post. You can Google this title here. You should be able to find a link to a post on ccmmarketmodel.com. If your mindset is, I need income, this post and the video in the post are probably both worth your time. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.